Milan, I think you need to turn on your camera.
Isaac, do you want me to go off for now?
Let me just contact Milan. Okay, he's back.
Okay. I don't know what happened to my camera. Okay, good. So, welcome everyone. It's good to see you all that made it tonight. I'm sorry that we had some conflicts, but at least it's going to be recorded, so hopefully everybody can benefit from Mark Yusko's wisdom this evening. This is our DeFi cryptos and all the things that we've never talked about before. I was just telling Mark that the Quant Society's been around for quite a while. It used to be called Quaff a Few, and that's more active in Boston these days. When I took over a couple of years back, we kind of relaunched and rebranded as Quaff a New. And kind of in the spirit of TEDx, hence the Quaffa X News. So it's a bit confusing. People often don't know how to pronounce it. But before we get started, just a couple of bookkeeping and housekeeping matters. I just want to thank Isaac, our event coordinator. I see that one of our ex-colleagues, Stefan's here tonight, which is fantastic. Isaac, thank you for making everything happen. I see Krishna there, and there's a few of our other folks that'll be joining. I mean, I know that a lot of our volunteers have to work late these days. They're always on. So we have the platform till 8:30, by the way, and it's a single speaker format now, so there's no rush. You got all the time. It's up to you. I've heard you speak before, and I know you've got lots of great ideas, so we'd love to hear about all of them. In terms of I think I'll skip a lot of the other stuff. Let's just sort of Mark's very distinguished bio. He runs Morgan Creek Capital Management, as well as the digital assets equivalent of this. So I guess you're a pioneer in the digital asset space, in addition to being a pioneer in the endowment model space of running UNC's endowment, Notre Dame, and of course he's been running Morgan Creek for quite a while, which is now close to $2 billion in assets. He's got degrees from Notre Dame as well as Chicago. I mean, we're here tonight to really talk more about the sorts of things he's doing as an early stage investor in blockchains, digital currency, et cetera, et cetera. So without further ado, let me hand it off to him. And, the Quaff a Few format's always been very informal, so people tend to, in real life, they tend to pipe in. They just tend to sort of jump in. And, here that's going to be a bit more orchestrated. I guess people put the questions in the side, and then I'll periodically jump in, but we don't want to detract from the flow. So hopefully you can get your presentation in share mode, and I'll just fade away.
Great. All right. Thank you very much. And great to be here with you tonight. It's kind of fun for me in that I almost became a quant, in the sense that, let's see if I can make sure I get this right. I went to University of Chicago, like Cliff Asness, and unlike Cliff, I bailed after my first class with Gene Fama, and didn't keep on that. So I ended up not as a quant, but worked at my alma mater at Notre Dame, and then at North Carolina down here in Chapel Hill, and then founded Morgan Creek 17 years ago. And 4 years ago, we made the deep dive into digital assets for Morgan Creek Digital. And I'm going to talk tonight about this idea of a hashtag I have on Twitter, hashtag #GetOffZero. The case for investing in digital assets, cryptocurrencies, DeFi, play to earn, the metaverse, all the things that are ahead. And I love this cartoon on the right, the digital divide. Look, if you ask anyone over 35, right? Who's your broker? Oh, Merrill Lynch, UBS, whatever. How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Oh, are you kidding me? It's a Ponzi scheme. 0. How much DeFi do you have? What's that? Ask anyone under 35. Okay. Who's your broker? What's that? You mean my Robinhood account? Yeah, I got a Robinhood account. How much gold do you have? Oh, are you kidding me? Boomer rocks, 0. How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really high percentage of my net worth and I'm embarrassed. How much DeFi do you use? Oh, every day. So there is a incredible digital divide. And we're going to talk about that tonight and then get into the heart of DeFi. So I'm going to speed slide. So don't worry about seeing everything on the slide. I'll point you where you need to go. A lot of slides will be up just for a couple seconds. And I put them up there just for effect. So first thing, a plan conceived in moderation must fail when circumstances are set in extremes. Doesn't say might fail. Doesn't say must do a little bit badly. It says must fail. Strong words. And we always overestimate the change that will occur in the next 2 years and underestimate the change that will occur in the next 10. Don't let yourself be lulled into inaction. Don't miss these big opportunities. Now, look, we are in a challenging investment environment. I don't have to tell you that. If you've looked at anything in the markets these days, valuations are super high. Interest rates are really low. It's really tough to make money. So what do? Look, if you risk, you have to take one of 4 risks. If you take no risk, you get the risk-free rate, hence the term. The long-term average risk-free rate is 4%. Today, it's closer to 2%. It's actually way less than 2%. It's about 1.3%. Trying to be charitable at 2. DM stands for developed markets. EM is emerging markets. You can make a little more in emerging markets. So you have to choose to take credit risk, equity risk, illiquidity risk, which is just private investments, or structuring risk, fancy term for leverage. And the problem is, in the current environment, bonds don't look attractive because you're not getting paid for credit risk. Equities look even less attractive, despite the fact that we're pumping them up on steroids with free money, which is part of the reason that digital assets are so important. Illiquidity premium's still there. That's pretty interesting. And it's not just one person, right? BlackRock, JP Morgan, Morningstar, research affiliates, GMO, everybody is basically saying stocks and bonds are going to have subpar returns for the next decade. The one place that you can make money is in venture capital, in private investments. Venture capital in particular, investing in innovation, can still compound in double digits. Now, if you look at the best investors in the world, Yale's a good example. David Swensen, God rest his soul, right, just passed. He pioneered this endowment model. He didn't invent it, but he pioneered it. And I and others followed in his footsteps. And look, they had 23% in venture capital. They are overweight innovation. And who do they overweight? Well, they overweight the best venture capitalists. Well, the best venture capitalists in the world today are focused on what? They're going to blockchain technology and digital assets. A16Z just raised $2.2 billion to invest in crypto. Now, I did a presentation on this idea of investing in innovation a couple weeks ago, and I love this cartoon. Is on the left-hand side, it's the innovation curve, right? Is you have the innovators, right? Hey, I got an idea. And then you have some early adopters saying, "Oh, cool, I like what's cool." But then you have this chasm, and it's filled with sharks, and it's basically how you get to the early majority who says, it looks interesting, but is it really for me? And eventually the laggards get there after everybody's made all the money. The realistic innovation distribution is the chasm is gigantic. Why is that? It's because the curse of incumbency. And so my pinned tweet on Twitter, so I'm at Mark Yusko if anybody cares, the greatest wealth is created by being an early investor in innovation. Making that investment requires believing in something before the majority of people understand it. Okay? You'll be mocked, ridiculed, and criticized for your non-consensus action. It's absolutely worth it. Now, the secret of change, this is not new, right? Socrates, 2,600 years ago. The secret of change to focus all of your energy, not on fighting the old, but on building the new. When the winds of change blow, some people build walls. Others build windmills. Ancient Chinese proverb, a couple thousand years old. Reasonable person adapts to the world. The unreasonable one persists in trying to adapt the world to themselves. Therefore, all progress, I love this, depends on the unreasonable person. In order to make progress, you have to be unreasonable. I believe you have to be willing to be misunderstood if you're going to innovate. Jeff might know a thing or two about innovation. If I'd asked the public what they wanted, they would have said a faster horse. Okay, from Henry Ford. The advancement of the arts from year to year taxes our credulity and seems to presage the arrival of the period when human improvement must end. I love the way they talked in the 1800s. It was just so awesome. But Henry Ellsworth, the head of the US Patent Office, basically said, everything that's been invented has been invented. Not so much. Don't be afraid to take big steps when indicated. You can't cross a chasm in 2 small jumps. Okay. So early investors in innovation make huge returns. So the telegraph, Western Union built the first telegraph line in 1864. Company was valued at $10 million. Within the next year, the valuation doubled. Okay. Over the next decade, the value grew by 11,000%. It was not a fad. Now, as technology evolves, picture on the left was Alexander Graham Bell's original picture of the telephone, the actual telephone, top middle, and then the one we've all seen, which wasn't really what he used, it was just a representation. And the telephone has too many shortcomings to be seriously considered as a means of communication. From William Orton, the president of Western Union. Shocking that the president of the company that does, telegraph thinks the telephone is stupid. Now, same problem, Western Union's still around, and now they're getting disrupted by blockchain and Bitcoin and DeFi. And we'll get to that in a little bit. So 1876, the Americans have need of the telephone, but we do not. We have plenty of messenger boys. I love that, from the British Post Office. So Henry Ford's lawyer, the horse is here to stay, but the automobile is a novelty, a fad. That was the president of the Michigan Savings Bank telling Horace Rackham not to invest in the Ford Motor Company. Well, a few years later, they had a few cars. And what's amazing is the biggest car company in 1903 was the American Electric Vehicle Corporation. So let that sink in for a second. So Elon Musk did not invent electric cars. They've been around forever. But what happened is Henry Ford bought the company, shelved the technology. If you go to the Dartmouth Engineering School in the basement, there is an electric car that went 46 miles to a charge from 1910. Pretty crazy. So math is hard, right? One of my other hashtags. The inability to imagine the unimaginable constrains most investors. So hence, if it requires, say, 1,000 years to fit easy flight a bird, which started with rudimentary wings, or 10,000 for one that started with no wings at all and had to sprout them ab initio, it might be assumed that flying machine, which really fly, might be evolved by the combined and continuous effort of mathematicians and mechanicians in 1 to 10 million years. That was in 1903, 2 months before the Wright brothers flew right here in North Carolina. And then Lindbergh, a few years later, flew around the world. Now, in 1949, everyone, okay, in quotes, I probably should put it in air quotes, everyone knew that computers were pretty much done, right? When a calculator like ENIAC is today equipped with 18,000 vacuum tubes and weighs 30 tons, computers in the future may have only 1,000 vacuum tubes and perhaps weigh just 1.5 tons from Popular Mechanics in 1949. And, Charles Darwin, I love this. It's very possible that one machine would suffice to solve all the problems that are demanded of it from the whole country. So basically, Charles Darwin, who was a pretty smart guy, said that we probably need 100 computers in the world. We got a few more than 100. Now, the early investments in technology are huge, right? Investing in Radio Corporation of America, from 1924 to 1929, you made 10, 11, 12 times your money. But the wireless music box has no imaginable commercial value. Who would pay for a message to be sent to no one in particular? Talking about wireless radio, and RCA went bust. Now, incumbents always misjudge innovation. They feel threatened by the disruptors. And so, but then the disruptors actually become incumbents. So while theoretically and technically television may be feasible, commercially and financially, it's impossible. So the father of radio, shockingly, the guy who invented radio is saying that television has no future. by 20 years later, television won't be able to hold any market it captures after the first 6 months. People will soon get tired of staring at a plywood box every night. Not so much. And so they got tired of staring at the furniture. And so now we have flat screen TVs, and now we carry little supercomputers in our hand everywhere with screens that we stare at all day. Check out your usage sometime. And then we had cable, and the television network said, oh, cable will never work. And then they said streaming would never work because the disruptors become the incumbents. Now, when things are called a fad, you should run out and buy as much as you possibly can with both hands. I've traveled the length and breadth of this country and talked with the best people, and I can assure you that data processing is a fad and won't last out the year. From the editor of Prentice Hall Books. So computers won't last out the year 1957. Okay, there's actually a company called Advanced Data Processing that has outperformed the S&P for a long time. DEC, right? The center of the universe in venture capital in the 1950s was not in Silicon Valley. It was actually in Boston or outside of Boston on Route 128. And there's this company called DEC, and there's another one called Wang and IBM. And the guy who started DEC started with $70,000 in venture capital. Okay. And a whole bunch of years later, 20 years later, it sold, I'm sorry, not 20 years, 40 years later, it sold for $9.6 billion to a personal computer company. So Ken Olsen, who founded it in 57, said in 77, there's no reason for any individual to have a computer in their home. And then they got bought by a personal computer company. I love that. So even the great innovators can underestimate change that will occur. So in 1981, Bill Gates, lower left corner, said no one will need more than 637 kilobytes of memory for a personal computer. 640 ought to cover it for just about everybody. Now, a lot of my friends don't work. I grew up in Seattle. A lot of my friends actually went to work for these guys. I always defend myself saying, if you saw that picture and you met those people, you probably wouldn't have gone to work for them either. But they're all multi-billionaires. I'm not. So I'm not making fun of them. I'm just saying we all looked rough in the 70s. They just looked rougher than most. Turns out Microsoft been a pretty good investment. Now, the problem is if you're early, you can actually have to endure periods of controversy, right? Evan sitting at his desk being interviewed for basically pirating the look and feel of Windows from Apple. Apple sued, and somehow Microsoft won. Maybe it's because Bill Gates' dad is a big lawyer. I don't know. But the stock basically did nothing for multiple years while that was happening. But if you held on, and there was never a good time to sell Microsoft, and it's been a pretty good investment over the years. So that's this whole question of blockchain. So why is blockchain technology so important? So Andy Grove, who started Intel, said there are very few skills as important and powerful as understanding when things change, because inflection points are defined as an event that changes the way we think and act. But the problem is you can't wait until you know. You actually have to invest before it's clear. And so the traditional way to think about inflection point is a wave of innovation. So this inflection point happens, a fad, right? It's called a fad. So say you should buy with both hands. And it becomes the next big thing. If you wait until it's mainstream, you're too late. But there's a different way to think about inflection points. And again, Andy Grove said, if you're wrong, you die. Okay. Most companies don't die because they're wrong. They die because they won't commit. They fritter away valuable resources attempting to make a decision. The greatest danger is standing still. You have to accept that change comes, and you're going to get this series, because it's not one point, it's a series. So the S curve that we all know, we learn in business school, is really important. It's the most important concept in business, is the S curve of adoption. But it's not a single curve, right? What happens is you have a series of S curves along and inside every single adoption curve. Now, innovation and disruption are driven by long cycle revolutions. in technology. So we had the manufacturing revolution in the 1700s, where we're basically taking muscle power and turning it into mechanical power. And then we had transportation and the energy revolution about railroads. Then we had this digital revolution where we're basically taking brain power and replacing mechanical power with brain power. So that was the electronic age. And now we're in the cognitive age. And this sixth epoch, there have been 5 big epochs over the centuries, and we're about to enter the 6th, beyond the age of information and telecommunications. This is the age of blockchain. Why? Very important chart on the left. So in 54, center of the universe was Route 128 in Boston, Dec and Wang, and they invented this thing called the mainframe. And now computers could go from governments to businesses, but you had to be a big business. You had to have a big building for a 3-ton computer. And then 68, there was this innovation out of DARPA out in Silicon Valley. And this guy, Don Valentine, invested in this little company called Intel, and kind of the rest is history. And suddenly microchips enabled computers to get smaller than 1.5 tons. And the center of the universe shifted to Silicon Valley. And 14 years later, now why it's always 14 years, actually I haven't figured out. I think it's because the creative class, it's always young people that invent the neat stuff, right? Whether it's Bill Gates when he looked like a 12-year-old, or whether it was Sergey and Larry, right, when they were in their 20s. It's always young people. And so it's about half a generation when you get these innovation waves. So in 1982, the personal computer, and Steve Ballmer's mom quipped, "Honey, why would you work for that company? No one would want a computer in the house," quoting the guy from Dec. I always joke, he has 18 billion reasons he was right, mom was wrong. Then 14 years later, the internet. And I was sitting at Notre Dame, and we invested with Don Valentine, who had just hired this guy, Michael Moritz, who had never done a deal. Sequoia was splitting into 2 firms. The old partners were pissed that he was hiring this guy who'd never done a deal. Turns out Michael's a pretty good venture capitalist. First deal was Yahoo, second deal was Google. We put $500,000 in this company called Google. I actually thought it was a dumb idea at the time. There were 20 search engines. Why did we need 21? What we didn't understand was today there are 1.7 billion websites. Half of them are owned by Google. Every time you enter a question into a search engine, they set up a new website unless they've already done it before. And that's why it's so fast, because they don't have to search the whole internet. They just go to the place that is running the website based on your question. That's called indexation. So we turned $500,000 into 200 million. And I had this aha moment that investing in innovation, investing in infrastructure, what my life was going to be all about. So the rest of my career, I focused on investing in innovation. So in 2010, I was back up in Seattle at Craig McCaw's house and asked his family office guy, do you think the mobile net is going to be as big as the internet? He says, "Mark, are you kidding me? Ask me if they want a computer, like whatever. Ask them if they want a mobile phone." I'm like, "Well, I already have 2. I probably don't need another one." So yeah, the mobile net's gonna be a big deal. And now we have handheld supercomputers, 1,000 times more powerful than the first supercomputer, in our hand. And all of them being connected, 10 billion connected devices, takes advantage of the network effect and makes it more valuable. Now the blockchain era, which starts in 2 years, in 2024, will usher in the greatest period of wealth creation we have ever seen. Why? Because blockchain is simply the next innovation in computing. When we had mainframes, they weren't connected. When we had client server technology, they were connected, but it sucked. It was hard and it was slow, and Netflix almost died twice because we didn't have broadband. Today, broadband doesn't even work. We need peer-to-peer interconnected blockchain technology to be the operating system for the internet of everything. Now, new technologies get adopted faster and faster and faster. So you can see it took about 100 years to get, radio and television to get into everybody's house. Indoor plumbing somewhere in North Carolina, they still don't have it. But you can see things like the internet or Amazon Prime, it happens almost overnight. You get half the population in a couple years. Now, it doesn't always work the way you think. On the left is pets.com. Okay. It was a perfect idea. Use the internet to get people their pet food. It is the poster child for the failure of the internet. Chewy.com is a $30 billion company. It's the same company, exactly the same. They do the exact same thing. But the reality was you needed multiple inflection points right? You needed beyond just the ability to have the internet, you needed broadband, you needed delivery technology, right? DoorDash is the same thing as Webvan, but it was ahead of its time. So the most valuable companies in the world today are not companies, they are networks. What does Amazon make? They don't make anything, right? They just match buyers and sellers and take a gigantic cut, up to 45% of the revenues, because they match buyers and sellers and they have this massive network effect. Same thing with Microsoft or Facebook, okay? The billions of users are a network, and networks are incredibly valuable. Why? Because if you think about the old days of a business, your costs grow linearly and your revenues grew linearly. But with a network, right, it's not linear growth, it's exponential growth, it's parabolic growth. So in the old world on the left, you focused on owning assets, you controlled assets. That was your competitive advantage. Today, it's about owning networks and owning people's habits. And the thing about exponential math versus linear math, the reason your profit margin goes up so fast at these network companies is people can't do math, right? If I say what's 2 times 2, everybody else say 4. What if I say what's 17 times 23? I'll wait, right? That's the limit of human intelligence. The average person can't do that without a calculator. Probably people on this call can, but most people can't do that. What if I say nonlinear regression? Probably not very good at it. And the thing is, if I take 20 linear steps across my library here, I get to the other side. If I take 20 exponential steps, I go around the world twice. It's awesome. So the math behind networks is very elegant and very compelling. So it starts with Sarnoff's law, and the value of the network increases in direct proportion to the size of the network. Okay, that was fine, but wrong. And Metcalfe came along and said, no, it's actually better than that. It increases proportional to the square of the number of users. So it's exponential. You guys have probably heard the story of the guy who did something nice for a king, and the king said, I'll give you whatever you want. What would you like? He says, all I want, king, is a grain of rice placed on a chessboard. And every day for 64 days, double the amount of rice. That's all I want. The king's like, that's great. That's all you want. You don't want gold. You don't want... Well, do 2 to the 63rd power, and you get 9 quintillion grains of rice. It's pretty much more than all the rice in the world. So the king would have to go buy the rice from all the other countries with the gold, and this guy would be the richest guy in the world from a single grain of rice. So exponential math is really important. So then Reed's law came along and said, now it's even better than that, because once the network forms, on the edge, you get subgroups that form. So like in a quant group, within the quant group, you'll have people that like football, like tennis, or like crocheting. Those subgroups then have a network effect of their own. So if you want to invest in these inflection points, you have to back transformational technology that doesn't exist, right? If I told you that more people will watch esports this year than any other league except the NFL, what would you say? You'd probably call BS. If I told you that the person who won the Fortnite World Championship made more money than the person who won Wimbledon, you'd say, geez, maybe I should play more Fortnite. So if I told you that 5G will revolutionize everything, and the reason we're fighting against China right now is because they're way ahead of us in 5G. If I told you that AI, they have more citations in China on AI than any place on the planet, they got 96% last year. So digital assets are right at the center of all of this. And look, we're in the digital age. The largest transportation company in the world today doesn't own any cars. The largest hospitality company doesn't own any buildings. It's not about assets. It's about networks. And everything is going to be disrupted. And digital innovation means we're going to take a handful of concepts: distributed ledgers, right? Immutable records, encrypted and programmable digital units, and a trustless way of having interaction between parties to exchange value without trusted third parties that will improve liquidity, lower cost, increase efficiency, and improve security. There is zero chance that this is not happening. There is zero chance that we will not move to the digital age. So a distributed ledger is simple. We've had ledgers forever. We used to be look, if I lent, Isaac, okay, another domer, okay, if I lent him money in the old days, I wrote down in my ledger how much he owed me. And he had to trust me that I wrote down the right amount. So the Medicis came along in the 1200s and said, that sucks. We need two ledgers. But if both people keep a ledger, if Isaac keeps a ledger and I keep a ledger, well, who's going to determine who wrote down the right amount? What if I cheated? So the Medici said, that will be us. So we'll create banks and we'll be the middle person. And the Rothschilds kind of took over, but we'll be the middle person. And that is a good 700-year run. But it's over, right? Because now we can use code to be the middle person. So we don't need a trusted third party. And a triple entry accounting system allows us to engage in a trustless manner without having to trust that middle person. And it's amazing. And if you think about that, that has broad and vast implications for everything that we do. Most importantly, centralized systems are inferior, right? They are subject to attack. They are not fault tolerant, and they can collude, right? People at the top, the cronies at the top, can make the rules, and the rest of us have to suffer, right? We were talking about before we got on the show. So decentralized systems are better, but distributed networks are the best. And the way to think about that is there's this thing called logically centralized or logically decentralized and architecturally centralized or decentralized. Think about a hierarchy of a corporation. Think about Napster. Napster was a corporation, one CEO, okay? They had a corporation, and they did something to allow people to share music. Now, the music industry didn't like it. So what do? You arrest the CEO and you blow up the server. So that is kaput. It's gone. Now, if it were a true decentralized sharing network like we have today with streaming, there's no way to end it. And the only way to access it, when you can have digital property rights through the form of tokenization, you get the ability to charge everybody for their use of music. It's better. So what blockchain technology does, it enables a single source of truth. It is the trust machine. And so I've dubbed it the trust net. So we had the internet, the mobile net, and in 2024, the trust net. Every industry that everyone you're thinking about working for, every industry out there will be impacted by blockchain technology. It's not just financial services. But this transition will usher in a period of the greatest wealth creation we have ever seen because of this decentralization of trust and the ability to transfer flow of value, okay, without intermediaries. If you think about the internet, what the internet did is allowed the two-way movement of information. In the old days, right, the church or government controlled the information, and we were basically servants to them. In the internet era, we've all been democratized because now we can exchange information peer-to-peer. Now, with blockchain, we can exchange value peer-to-peer with unique digital assets. So what the internet did to media and commerce, blockchain will do to financial services. WEF called it the beating heart of the new financial system. Look, banks have been under attack forever. In fact, in the digital age, do we really need a bank? Do you need to go to a bank, to a building, talk to a person? No. Do you need to wait 30 days to go get a home equity line of credit? No. You can go to Figure Technologies, one of our biggest investments, and get it in 5 days. Get approved in 5 minutes, get your money in 5 days. And they'll issue that home equity line of credit on chain, so it settles in real time, not T+3. So banks are under attack. But here's the real problem. 40% of adults in the world don't have a bank account. Let that sink in for a second. 40% of adults in the world don't have a bank account, but 2/3 of them have a mobile phone. So we can deliver financial services to them using, okay, blockchain technology. For example, if I had a mother-in-law in Brazil, which I don't, my mother-in-law is in Tulsa, but if I did have a mother-in-law in Brazil and I want to send her some money through a remittance, she would get about 70 cents on the dollar because Western Union, which amazingly still exists, charges about 30%. Now, they don't get all of it. The Rothschilds get a whole bunch because there are 2 treaties that go back about 400 years that say any money that transfers across international borders has to pay Standard Chartered and BIS. So that's silly. So I could transfer her Bitcoin for free instantaneously, and she gets 100 cents on the dollar. It's better. So traditional finance is migrating to centralized finance, TradFi, CFI, which is then migrating to DeFi. Well, what is centralized finance? Well, centralized finance is just a better form of banking, right? It's centralized finance, like Coinbase is a good example. Coinbase is centralized, right? If you put your digital assets at Coinbase, you no longer own those assets. Coinbase does. They're in their wallet. You don't have your keys. Now, there are a whole bunch of people, kind of anarchists and Bitcoin maxis, who say, oh, not your keys, not your coins. Well, here's the thing. My 83-year-old dad, who loves Bitcoin, is never going to hold his own keys. I don't want him to hold his own keys. He's perfectly happy having a Coinbase account and paying some money for the safety and security. Because remember, digital assets are bearer assets. They can be lost. They actually can be stolen. It's hard, but they can be stolen. And so having a centralized authority actually makes some sense. It's kind of like banks, right? I have money. It sits in a bank. It's no longer my money. It's the bank's money. I have an IOU from the bank. I'm comfortable having an IOU from Coinbase for my USDC. Now, there are other things I want to hold directly on chain as we move into a decentralized world. And so the underlying technology for both centralized finance and decentralized finance is blockchain. Everything in the world will be on blockchain. Blockchain is the operating system, the same way that mainframes operated on COBOL, right? Then the microchip technology enabled personal computers, which ran on Windows and DOS, disk operating system. Then the internet came along and it runs on TCP/IP. We're using it right now to communicate. Then the mobile net came along and we have iOS and Android. Think about this. Google in 2005 bought Android. Everybody laughed at them. What do you know about operating systems? That's so stupid. Now they have 80% market share of handheld cellular phones around the world, 80%. Pretty good investment. And in the future, okay, the trust net will run on blockchains. Everything will be connected by blockchains. Now, digital assets, including cryptocurrencies, so not just cryptocurrency, digital assets include everything that is unique and has property rights, whether it's art, collectibles, property, everything in the world will ultimately be tokenized. And there'll be tokens the same way we think about websites. And there's a great thread by Chris Dixon on this just the other day, that websites allow us to exchange information two ways. Tokens will allow us to exchange value two ways, and everything will be tokenized. Now, there'll be people who keep their tokens in a custodial account in a centralized finance like, BlockFi or Coinbase or Kraken. There'll be others that want to own on-chain directly in Ledger, another one of our portfolio companies, where you have a little dongle that you plug into your computer and you can hold in cold storage your keys, your coins. Now, we're going to have things like governance and regulation. So governance in a centralized organization has still got people at the top, right? Brian Armstrong is the CEO of Coinbase. In decentralized finance, they have these things called DAOs, decentralized autonomous organizations, where the community actually can vote on how you use the assets. For example, if you think about some of the decentralized finance protocols like Aave, the DAO can decide how much of the profits that are made by the protocol get distributed back to the owners. It's pretty amazing. If you think about TCP/IP, Tim Berners-Lee invented the internet, not a rich guy, because he didn't own TCP/IP. In the future, you and I can own these liquid protocols and benefit. So bunch of other things here on examples. So platforms like Nexo or Binance, depending on where you live, versus MakerDAO, Compound, and Aave, true DeFi protocols. So not all financial services need to be decentralized. The vast majority of them, though, are way better off. And there's this flow chart on the left in words and on the right in pictures. You just ask yourself a series of questions. Is there a transfer of value? If no, then it doesn't need to be in financial services. If yes, yeah. Is it going to be on a public blockchain? Nope. Goes to traditional banking. If yes, if you want it on a publicly immutable public ledger, which I think everything will go to, then it's going to be in decentralized services or ultimately DeFi. Now, if we think about protocols, if you think about the internet, there used to be 70 protocols. Today, there are 5, right? There's TCP/IP at the base layer. There's SMTP for email. There's HTTP for websites. There's FTP for files. And there's www that ties everything together. In the future, there will be settlement layers. There'll be asset layers. There'll be application layers. There'll be aggregation layers. All of this is going to happen on chain. And all of it is going to happen as the talent, right, that comes from every place on the planet migrates into this space. I've seen 2 great waves of talent migration. One in the 90s into the internet. The second today into things like DeFi. And if you think about how the world is set up, this maps, so DeFi Adoption 2020 basically mapped some of the existing protocols, companies, and organizations, networks and organizations that make up the base layers, right? So in my world, Bitcoin is kind of like the base layer. On top of that, we have Filecoin, which basically does what FTP does. Then you've got competing, Polkadot, Cosmos, maybe Solana, that are competing, right, for supremacy in those middle layers, kind of like HTTP and SMTP. And then on top of it, I kind of think Ethereum is the www dot, 3 W's, of the internet of value. Now, on top of that, we're going to have applications that get built. We're going to have services, things like stable coins, like US dollar coin. We're going to have companies or systems, I shouldn't say call them companies, systems like synthetics that allow us to create synthetic assets using on-chain protocols. And so everything that we do in the traditional world of finance will migrate to DeFi, all of it. And there are so many ways to invest. You can invest in the VC of companies. We've done that in many cases, companies on here. We've also invested in the liquid protocols themselves, because owning Bitcoin today is like owning a Series E investment in a venture capital-based startup, right? It used to be a Series B or a Series A or even a pre-seed. It was a science project 12 years ago. It was kind of a seed stage project 5 years ago. When we invested in 2018, it was a Series B at around $4,000. Today, it's like a Series E. I still think it'll go up 10x from easily, and it could go up 100x if it becomes not just the gold equivalent for store of value, but replaces all of global M2, about 86 trillion. So it could be 100x from here. Why not own some of that? But I think there's bigger upside for Ethereum, which is kind of the www dot. And I think there might even be bigger upside to things like Polkadot or Cosmos or Solana, which will become bigger and bigger elements as more and more things tokenize and get transferred. So there's been unbelievable DeFi development activity over the past couple of years, and it's across all aspects of financial services, from the issuance of securities to the trading of securities to the actual ownership of assets. And we haven't even touched on things like NFTs. We haven't even touched on play to earn, right? My son, my 10-year-old, got me involved in Pokemon Go. And just how much I love you guys, I'm giving up raid hour tonight on Pokemon Go just to be with you. I'm just kidding. I mean, I'm not kidding around. I'm actually serious. But there's a company, Pokemon Go is a big multi-billion-dollar business. Fortnite, big multi-billion-dollar business. Axie Infinity, which is a liquid protocol that is based on a game that kind of is a ripoff of Pokemon. Long story short, it's been around a few years. It caught on. Last year, last 12 months, they grossed more than Fortnite. And some of that money goes back to the owners of the protocol. So the protocol has done really well as well. That's just one example. This thing Loot, which I don't know if you followed that. Loot is amazing, right? You created physical NFT objects, just a list of random objects that you might use in a video game. And now developers are developing games around these objects, and the value of the objects is skyrocketing, and the value of the ecosystem is growing organically as the best and brightest focus in an open source world on developing this play to earn platform. Mind-boggling stuff. So if we think about the history of DeFi, it's actually relatively short, right? Bitcoin goes all the way back to 2009. Then we have things like Maker and Ethereum that really came in 2014, 15. Then we have Aave, which is only 3 years old. I mean, amazing to think about that. You got Uniswap, and you had the DeFi winter in 2020. So around the, crackdown on COVID, basically everybody ran from DeFi, ran from crypto. I mean, Bitcoin went down 50%, Ethereum went down like 65%. And a lot of these DeFi protocols were down 90%, 90. And investing is the funny thing. Investing is the only place I know when things go on sale, everyone runs out of the store. And the cheaper the price, the further they run. And all you had to do is stay in the store, or maybe even buy some of the stuff on sale. And if you think about the depiction, the cartoon on the right, so DeFi, which is up on top, which integrates blockchain technology, which is the 3-bar thing on the bottom, chain of blocks, blockchain. Ethereum at the heart of this, the nucleus of this organic, living, breathing organism. Bitcoin will play a role. And basically what you've got is all of human trading, human exchange of value is going to migrate into this. And so I've been saying for a long time that we're so early. It's like the Star Spangled Banner just finished. And I was up at this conference in New York last week, and they're like, no, Mark, players are just entering the stadium, right? They haven't even started anything. They haven't done warm-ups. So look, blockchain will enable the transition to the digital age of securities. If you think about the analog age, right? I used to have a physical piece of paper. Isaac would have a physical piece of paper. I'd have money. He'd have a stock certificate. We'd meet under the Buttonwood tree in downtown, right near where I did the DAS presentation. And the problem was, if you've seen the movie Gangs of New York, walking to the Buttonwood tree was hazardous to your health, right? You get mugged, you get robbed, get a wrench attack, and they'd steal your bearer asset. So they turned those bearer assets into electronic securities. And now we do everything electronically using QSIPs. But the actual physical piece of paper still exists at a thing called DTCC in Dallas, Texas. And they process $1.8 quadrillion of volume every year. Okay, think about that. Big number. Very profitable, owned by the banks. They get a little kickback from it. And they don't want that to go away. Well, Mike Cagney invented something called the Provenance Blockchain that could completely disrupt DTCC and could allow us to trade digital securities at lower fees. Now think about, in the old days, Isaac and I had to be physically in the same place. We had to proximate. In the electronic age, I can trade with somebody around the world. In the digital age, I can trade with anyone, anywhere, anytime. I don't have to wait for markets to be open, right? It becomes a truly global, borderless world. So tokenization is just a logical progression of the digital disruption of real assets. And every year, $14 trillion of equity, loans, real estate, commodities, art trades hands. Every year, 14 trillion. And all of that is going to migrate on chain. And beyond the 14 trillion a year, all of global assets, about 700 trillion. And remember, 1 trillion is $1 every second for 31,710 years. Trillion's a big number. $700 trillion of assets will move. So every stock, every bond, every currency, every commodity, every asset in the world, every piece of real estate, every piece of fine art, every bottle of wine, every collectible car, everything will be tokenized, and we'll have tokens the same way we think about websites, and we will exchange value seamlessly, borderlessly, 24/7. So let's just take one use case, money. Now, the history of commodity money, pun intended, pretty solid. Fiat, not so much, right? There have been 875 paper currencies in the history of the world. 3/4 of them no longer exist, right? Pound sterling, the oldest paper currency still alive, has lost 99% of its value. It used to take 1 pound of silver to get a pound note. Now it takes 184 pounds of silver to get a pound note. But everybody says, no, these aren't currencies. Bitcoin's not a currency, okay? Has nothing behind it. Neither does any currency. No currency has anything behind it. If you take a green piece of paper and you turn it into the government, what do you get? You get nothing. You don't get a share of taxes. You don't get gold or silver. And by the way, we like green pieces of paper. In Israel, they like yellow pieces of paper. And in China, they like red pieces of paper. So your green piece of paper, although it's widely accepted, is not worth as much in other places around the world. Now, the other thing is the Lindy effect, right? The longer you survive, you will survive, right? Life expectancy isn't as much about living longer. It's about not dying at childbirth or when you're 5 or when you're 12 or when you're 60. So if you make it past these certain milestones, you live longer. And that's the same thing in financial services. So we are early, right? We're not even at a reliable store of value because there's too much volatility. Well, there's only volatility because people don't understand. There's not enough people that use the asset yet to understand it. So we are in 1997, right? 1997. So it's like investing in Google and Yahoo and eBay and Amazon in 1997. It was really profitable. So you should probably get some. Now, network at value follows an S curve, just like every other adoption of technology. Now, here's the thing about math, right? This is a model that was done in 2014, okay? Logarithmic nonlinear regression. And it basically is Metcalfe's law applied to the Bitcoin blockchain. And it basically says the value of the network follows the red line. The price is a liar, right? The price of an asset is not the value of the asset. The price is what two people agree to exchange a small amount at a certain point in time. And what the model said is in 2017, the value of the network based on the number of users in the network in Metcalfe's law was $10,000 within 6 days of that number. And then we flew all the way to 20,000. That was too high. And then we crashed all the way to 6,000 and then eventually hit 3,000. And now we're back at, 46,000 or wherever, 42,000, wherever we are. Now, the model said we were going to be at 100,000 in July of this year. So everybody says, oh, the model's wrong. Well, no, it means the price is probably wrong. The price can be lower than the model or it can be above the model. And actually the way the model works is it has to be below the red line as long as it's above the red line. That's how averages actually work, right? If the average of the number is 10 and you have a bunch of time at 15, you have to have a bunch of time at 5 to get back to 10. So another way to think about this is something called stock to flow. So this is a model created based on the halving of Bitcoin. Every 4 years, they cut the size of block rewards in half. And if you think about that, that's an elegant way of mandating that the price will rise over time because the miners, who are the people who secure the network and make it the safest computing network in the history of mankind, been up for 12 years, never had one fraudulent transaction. Visa, MasterCard get hacked all the time. How many times you had to get a new Visa number because of fraud? Bitcoin never been hacked, not one time, not ever, okay? Because it's super secure. It's really slow, but it's super secure. And so what this is saying is that the value of Bitcoin should be somewhere around $100,000 this year. Interesting. Now, I love this chart, right? Again, logarithmic instead of linear. Always do long-term charts, logarithmic, by the way. And what it shows is stores of value. Red is real estate, yellow is gold, silver is silver, and white is where Bitcoin is today. And Bitcoin, I'm sorry, white is diamonds, and Bitcoin is the red dots that are moving up toward gold equivalents. When we get to gold equivalents, which would be about $8 trillion in market cap from the current 800 billion, that's about a 10x from here. It's pretty good. Now, if you listen to the media, crypto is done, right? It's a perfect storm, everything's bad. If you actually look at the reality, it's the exact opposite, right? In fact, I don't even know what the opposite of perfect storm is. I mean, perfect storm is the wrong analogy because in the perfect storm, market goes down with the ship. This is the perfect high because we have democratic socialism. We got this stupid thing called MMT, one of the dumbest things ever. We got QE infinity. We got 10,000 boomers every day in the United States that retire. Same thing in Europe. We had the elections. We had the halving. So all of the things are telling us that Bitcoin's getting better. And we are way early, right? Bitcoin today is 800 billion. All of crypto is 2.4 trillion. That's Apple. That's one stock. And there is a massive wall of money in institutions that is going to go into crypto. Why? Because in 3 years, you'll be deemed irresponsible as a fiduciary if you don't own crypto. So here's the crazy thing. Bitcoin last year, 2020, was the best performing asset. Again, as it was the year before that and the year before that and the year before that. This year, it's the best performing asset. Despite all the volatility, up and down and up and down, it's still up way more than stocks. And stocks are having a great year, up 20%, but Bitcoin's up 50. Here's the thing. Bitcoin is a network. It's equivalent to the other FANG networks, but it's going to eventually be gold, which is 8 trillion. And could it actually be the global money? It's a better form of money. Money exists in the absence of a liability. The only money in the world is gold. Everything else is currency. Currency has a global debt associated with it. Bitcoin has no debt associated with it, so it's digital gold. It is perfect money. Could it displace, using Gresham's law, all the bad money in the world over the next few centuries? Next few decades? Yeah, it could. It's going to go up 100x. Shouldn't you own some of that? Probably. Look, PayPal and Cash App more than the new supply of Bitcoin every month. And this guy, Michael Saylor, he likes it too. Now he's bought, I think, closer to 3.5 trillion instead of 2.5. The landscape is changing. Simple construct that I learned at Chicago, and you guys have all learned. If you add an uncorrelated asset to your portfolio, you move up and to the left, right? You get better return with lower volatility. Here's the thing. Stocks and bonds are highly correlated. Stocks and hedge funds are highly correlated. International stocks and US stocks are highly correlated. Bitcoin is uncorrelated to stocks and bonds. Why? It's 0.15 correlated to equity, 0% correlated to bonds. Why? Because the things that drive the returns, corporate profits, economic growth, interest rates, productivity, that drive stocks and bonds are not what drive crypto. Crypto is driven by millennials, because millennials are going to own it, digital natives, by user growth, by network adoption, by regulatory changes, and the technology itself. So here's the thing. 5 years ago, you took 1% of your portfolio, 60-40, went 40, 39.5, 59.5, and you put 1% in Bitcoin. Instead of making 7.2, you made 9.2, 200 basis points better. That's awesome. Now, the cool part is, had it gone to 0, which was impossible, but let's say it could have happened, you still would have made 7. That's a 10-to-1 upside downside. It's the best diversifying asset I've ever seen in my career. So you can ignore it and hope it goes away. It ain't going away. It's now 2.4 trillion. I can't update this slide fast enough. 2 ways to invest, either in the picks and shovels through venture capital. We run venture capital funds that do that. We also have a risk managed Bitcoin fund. That is me. And I'll turn it back to you guys, and I'll answer some questions if you got it, or I'll let you go.
Wow, that was pretty amazing. So a lot of ground you've covered, Mark. Thank you. I'm sorry you can't hear the round of applause.
That's all right. No worries.
But on behalf of
we'll get the virtual applause later online.
Absolutely, and I certainly hope that you're going to join us for dinner when you're in town. I have a bunch of questions for you, but I want to see what people are saying over here. So we have Gurpreet Singh who's asking, what are your thoughts on El Salvador?
Look, El Salvador is big. I mean, it is the first of many that will deem Bitcoin legal tender. Look, we're investors, full disclosure, we're meaningful investors in Strike, Jack Mallers' company. Jack went to El Salvador. He convinced the president to enact this legislation that would make Bitcoin a legal tender. And part of the reason is, in El Salvador, it's not 70 cents on the dollar, it's 50 cents on the dollar. You send remittances back to El Salvador, you get 50 cents on the dollar. Zap or Strike, that's, Zap is the company, Strike is the app. I can send pesos to El Salvador for free, and they can get 100 cents on the dollar. So using the Bitcoin blockchain. So Strike is fastest growing app in El Salvador. El Salvador is big because after El Salvador, you can see Paraguay or Brazil or any number. Panama has talked about it. And ultimately, every country is going to have to recognize it as a legal tender, not the legal tender, but a legal tender. It's kind of like China, right? China for years has wanted to be a world reserve currency, not the world reserve currency, but a world reserve currency. They did that. It's now part of the IMF SDR. And ultimately, they do want to be the world reserve currency, and they will be the world reserve currency at some point, because all empires fall. And, British Empire fell, American Empire is falling, Chinese Empire is rising. We'll see how that goes. But ultimately, the global borderless nature of Bitcoin will make it ascend into a role as a world reserve. Maybe not the, but definitely a. And this is just the first step.
So, Mark, you had a whole bunch of the kind of, participants in this new era of the blockchain and all these companies that many of us haven't heard about. But in terms of, what's public, what's investable, if the average person, some of us may not have access to VC funds or Reg D offerings, are any of these public that we could just go and buy?
Oh, my gosh. Yeah. I mean, see, this, the great thing about all of this is you can do it all on your own, right? Anyone here can buy Bitcoin directly, can buy Ethereum directly, can buy any of the DeFi protocols directly. And I would encourage everyone to do it, right? Set up if you want to, start slow, set up an account at Coinbase or Kraken or Gemini. We're leading Gemini's latest round. So maybe I prefer Gemini right now because we already made our money on Coinbase. So I like what the Winklevoss twins are doing, and they've got a huge lead in NFTs with the Nifty Gateway. Account and buy some. Or if you're really tech savvy, which most of the people on this call are, you can just do it yourself, right? You can download a wallet and you can, now don't hold lots of assets on your wallet. If you think about money, right? How much money has been stolen from the Federal Reserve? $0. How about Bank of America's tower in New York? $0. How about Bank of America El Paso? More than $0. How about people's wall safe? Definitely more than $0. How about people's purse or wallet? Lots. So the further you are from the source of the money, the more risk you are. So I don't keep any crypto on my phone. None. Zero. I've been SIM swapped twice. By the way, if anyone uses their phone number for two-factor authentication, stop right now. Definitely use a second email address. Never use your phone number. It's too easy to do a SIM swap and you'll lose everything. So first thing is, download a wallet, buy some stuff, play with it, go on Aave and loan some money, right? You can loan money to anyone, anywhere in the world on Aave and get paid. You can stake your coins on different protocols and earn yield. So you can go to BlockFi, again, one of our big portfolio companies. You can convert fiat money where you earn $0, right? You can convert it to a stable coin and you can make 6 to 8%. It's because the supply and demand for digital assets is so out of whack relative to fiat assets. We are a wash in fiat currency. Here's a stat you won't believe. 40% of all the US dollars in the history of the Republic were created in the last 18 months. Just let that sink in for a second. We've been around for 250 years. Okay. The value of a dollar was $1 from 1776 to 1913. In 1913, we created the creature from Jekyll Island. And there's been a systematic devalue of the currency, down 94% since then. And what that does is through this ruse called inflation, we steal wealth from the poor and give it to the rich. That's what inflation is. It is a wealth tax. The rich, and that's their only job, and all the central banks around the world. So fiat, think about it. If I had $1 million sitting right here and someone prints another $1 million, what happened to the value of my $1 million? It just fell in half. That's what printing money does. Bitcoin is sound money. There can only ever be 21 million in the history of mankind. There will never be more. There'll actually be less because some gets lost or stolen. And that increases in value as the more participants own it. So it is deflationary currency as opposed to inflationary currency, and it protects our ownership. Think about, you all use credit cards, right? I love my American Airlines credit card, right? I get miles, okay? But here's the thing. They devalue my miles every year by increasing the amount of miles I need to get a ticket. That's bullshit, right? That's fiat devaluation. If I get a credit card from BlockFi and I get paid in Bitcoin, my value accretes. It doesn't get devalued. So why wouldn't I want my rewards in Bitcoin instead of airline miles? Simple.
So that's an interesting point. I'm a little, unclear about. So this is a very often made argument about the scarcity value, even if there's no intrinsic value. But on the other hand, I've also heard the counter that, well, there's nothing stopping these currencies from forking, and you can create infinitely many, you can create as many coins as you want, right? And there are many of them in circulation, like Dogecoin, which was supposed to be a joke. So how does one really assign value to something when you can just go and write a few lines of code and create a new one?
Well, again, it's a great question, but it's not a new one, right? It's totally different. It's a utility token, right? There's a difference between a cryptocurrency, which is used as a medium of exchange or a store of value, and a utility token, which is just traded between people. And look, there are 3,000 utility tokens. 98% of them will go to zero. But the 2% that don't will go up a lot, because some of them will actually back real projects. Okay. Others will become enough of a store of value in that enough people own it. Like you say, Doge started as a joke, but enough crazy people bought it so that now it actually has enough network value that they could go out and actually develop some use cases. It's kind of like what happened with GameStop. GameStop equity was worthless, right? Yep. Their liabilities exceeded their assets. Stock was worthless. But the predators or Redditors, right, ganged up, did a pack of jackals attack on the short sellers, caused a squeeze, which allowed the company to issue new equity to get real money, which now they won't go bankrupt. Mm-hmm. And now they have a shot at, now I still think it's way overvalued, but that's called reflexivity. Soros wrote about this in his book. By the way, the first book where Soros introduced the idea of reflexivity, one of the worst books ever written. It's so horrible. I mean, the second book is actually readable. And reflexivity is one of the most important concepts in finance, that things that occur can impact other things and make them better. Like excess debt on a company like Evergrande can cause the company to go away, right? The actual burden of the debt reflexively changes the value of the asset. Just like the right amount of debt can actually increase the value. Think about your home. We all buy homes with 20% down, 80% mortgage. If the price goes up 10%, we don't make 10%, we make 50%. That's awesome, right? Now, the problem is when we got to 1% down and 99% mortgages, now if the price went down 1%, we lose not 1%, but 100%. So leverage can never make a good investment, a bad investment good, but it can make a good investment bad. It's like crypto, right? If you buy crypto on Binance or one of these crazy things where you get 100 times leverage, personally, I think you're an idiot, right? Because you will eventually get margin called and they will take your Bitcoin. In fact, I have a friend called me up and said, they stole my Bitcoin. Like, no one stole your Bitcoin. You made the decision to take 100 times leverage in an 80 vol asset. You deserve to lose your Bitcoin. I hate to say it that way.
So who's providing that kind of leverage? I mean, I'm still trying to figure out the ecosystem. What
So the bottom line is you have people in, because you got to think about crypto. It's a global asset. The U.S. is between 15 and 20% of volume. The rest of the world is the bulk of the volume. China is still the biggest market, despite all the protestations to the contrary. Binance is the largest exchange in the world, run by CZ in China, but it's really everywhere. I mean, he has taken every market other than US. He doesn't really have a US presence much, too much regulatory risk. And what he's built is pretty amazing. Now, the problem I have personally is he allows people to, at one point, take 125 times leverage. I think that's wrong. They've cut it back. I still think you can get 100. Hopefully it'll keep coming down. But I just think that's legalized gambling. That's not investing. So there are other exchanges. Coinbase is the 6th largest exchange, right? We think they're number 1. They're number 6. And the problem is the other 5 are outside the US. Now, the biggest story recently is FTX. FTX, it's only a 3-year-old company. It just got valued at $18 billion. We have a little investment that just became a big investment. And the key is that they were an international fund that did something that was really unrelated to crypto. They decided to get into crypto. And look, their CEO, guy's a genius. I mean, he's executing on all cylinders. He's naming football stadiums. He named the Cal Berkeley. I didn't even know you could name a college stadium. And he is creating a brand. He's got Tom Brady as a spokesman and Gronk. I mean, the guy is a marketing genius, and that is reflexive, right? People see that marketing push, and it creates demand for his product. I think that has a chance to be one of the big dogs. So that's a kind of a meandering answer to your question, but there's so many firms around the world that are just dominant. France has got some dominant companies, Ledger being one of them. They call it in Germany and Berlin. They've got some great developers around crypto. Bahamas actually has some hotbed of activity. Puerto Rico now has a lot of crypto activity. Lots of really, really smart people around the world. And like I said, this migration of talent into this space dwarfs everything. There's more talent migrating into cryptocurrency, DeFi, gaming, metaverse. I mean, we haven't even talked about the metaverse. The metaverse is unbelievable, right? We have today virtual worlds where people buy virtual goods and services, set up virtual businesses, and are earning a living in the virtual world. Here's one of my favorites. So Axie Infinity, it's this game. It's like there are people who were migrant farm workers, basically making $1 a day, who quit that horrible backbreaking work, managed to buy a couple Axies. You can breed these things by accumulating potions, and you can then sell them. The price has gone ballistic because of the demand for the game, and these people are now making thousands of dollars a year, which is a way better life than they had before, working in the metaverse as opposed to being migrant laborers. It's amazing. I think it's totally cool.
That is pretty amazing. Your FTX story is also quite interesting because we've certainly seen a lot of the talent migrate from the traditional stat-arb market making world. A lot of the quantum and all of those FTX guys used to be stat-arb folks at Jane Street, and they've hired a lot of the quants that usually come to our meetings. They're hiring aggressively from all the programs represented here.
Well, look, there's the question about what do we think of systematic quant strategies? That is one of the big growth areas. I mean, jump trading, just put $350 million in a fund. Look, I went out to see the Susquehanna guys. It was unbelievable. I mean, they have 2 football fields full of people and computers, all focused on crypto. All the big shops have spent lots of money hiring talent. And the reason systematic works in crypto is if you think about CTAs, trend following, all the early quant stuff in traditional markets, it worked great when spreads were decent. Decimalization killed that. It worked great when we had, not 24/7 trading and human beings were involved. When the machines got involved, the spreads came down, narrowed, and it's really tough except for the really biggest, fastest, super HFTs to make money in the traditional world. Crypto, you can drive a truck literally through the spread between a Singapore exchange and a, Eastern Europe exchange. And if you have the ability to execute on those multiple exchanges, whether it's Binance or whether it's, FTX or whether it's Wobi or any number. I mean, I think there are 220 exchanges at last count. Some of them do literally tens of thousands of dollars a day. Some do tens of billions. But there are massive inefficiencies. And it's like the good old days. There's a story I love. There was this guy, he was a math teacher in Chicago, and he used to go into the options exchange, and he was crushing it. And he literally got banned. So he went out to California and was arbing the spread between the Pacific Exchange and the Chicago Exchange, and he got banned from that. So he moved back to Chicago and became Hull Trading, which then Goldman Sachs bought. And those days are over in the traditional markets, but they're just starting in the crypto space, and everything from stat arb to vol arb to any number of quantitative strategies are very profitable. Is it costly to short? Depends who you're partnering with. It's less costly than it used to be because there's more supply, more firms getting into these earn products, so they have inventory to lend. Prime brokerage is finally kind of coming together in the space. I used to say, 10 years ago, if I were 26 and unmarried, neither of which I am, I would move to Mumbai or Shanghai. Now, I just say it doesn't matter where you are, I would just get into crypto. I mean, that's what I would do.
So do you think, from everything you've described, it sounds like maybe one of the key sort of features that might distinguish the winners from losers would be kind of the network effect and Metcalfe's law, right? I mean, you're describing
100%.
how so many coins have come into existence, and of course, most of them won't survive, but presumably the ones that have the critical mass of the following, your Bitcoin and Ethereum and a couple of these might actually.
Well, it's even better than that. In an open source world, I remember the Benchmark Capital guys coming to North Carolina to pitch me on this company they were starting in North Carolina called Red Hat. And I was like, what? You're going to give away software? How is that a good business? And then they sold to IBM for $40 billion. It's a really good business. Open source changed the world. So everybody says, why isn't Bitcoin MySpace? Because it can't be. MySpace is MySpace because the Winklevoss twins invented something, Zuck stole it, and created Facebook, which was better technology. So MySpace goes away. MySpace was first. Okay, better technology wins because it was a closed source world. Today in open source, if you invent something better, I can take it and copy paste onto Bitcoin, and my blockchain is better. And because Bitcoin is the first mover, has the network effect. Look, Paul Romer won the Nobel Prize 3 years ago for this. He created something called the law of increasing returns. And he said that it's not the best technology that wins. It's the technology that gets critical mass first. And that's exactly what happens in new technological innovation, but it's exacerbated now because of open source. Open source allows us to migrate all the best features and all the talent and all the brains onto the thing that has the best. And that's why Amazon's as big as it is, and Apple, they just have a huge advantage in an open source world.
Right. So, I'm curious about the energy efficiency aspect of all of this, because many of us don't really understand what's involved with the
total FUD, right? Here's the thing. Incumbents will always spread FUD, fear, uncertainty, and doubt about the disruptive technology. So most people don't know that in downtown New York, there are these old buildings and the stoops are 9 feet above street level. Why is that? Why is the door 9 feet above street level? Well, because of horse shit. So when there were horse-drawn carriages, the horse poop would pile up and they would sweep it to the side and it'd pile up 4 or 5 feet. And the ladies didn't like her dresses dragging it. So they built elevated sidewalks, and the stoops of the wealthy people's homes were 9 feet above street level. Now, those elevated sidewalks were great, except if you were drunk late at night and you fell in the pile of poop, but that was bad. So when the horseless carriage came out, what did the street sweepers do? They hand out pamphlets saying, if you get in a horseless carriage, you'll die. So when my grandfather-in-law left a safe job at the train company to go to work for American Airlines, what did his parents say? You're an idiot. What did the train companies do? They passed out pamphlets saying you'll die if you get on an airplane because if you go too fast, your body will cave in on itself. Obviously, it doesn't happen. And so whenever disruptive technology starts to take over, the incumbents spread fear, uncertainty, and doubt. So this ESG thing is just hilarious, right? Everything we do in the world, everything we do every day is about turning energy into value. get up in the morning, we put fuel in our body, we do something, we add value to the world, we turn energy into value. You turn on a machine, turns energy into value, right? I turn on the lights, we have power to do this Zoom, we're turning energy into value. Banking industry uses 2,100 times more energy than Bitcoin. Gold mining industry uses 60 times more energy than Bitcoin. Bitcoin is the perfect creation of energy to value. And I'll give you the best example that is actually good for the environment. No one talks about it. So in West Texas, you ever seen the picture of the US at night? You see North Dakota and West Texas lit up because they're flaring gas, because there are no pipelines. So you drill for oil, you get about 10% gas, hydrocarbons come out, they set them on fire, bad for the environment. So now you can take a microturbine, cap the gas, fire up the microturbine, put a Bitcoin miner on it, take that Bitcoin and send it through the internet anywhere in the world, instant store of value. We're now decreasing pollution, we're increasing the value in the world, and we don't have to create any pipelines, no transmission wires, no right-of-ways, no digging. Perfect creation or transition of value, energy to value. And so the other thing is mining is only profitable if your cost of electricity is low. The lowest cost of electricity is hydro and renewables. So all of Bitcoin mining is migrating to renewable, which is greener than green and will accelerate the greening of the world, not hurt it. So don't listen to the FUD. Look, Jamie Dimon called it a fraud, yet he has a whole department. They put out 196 research paper, and now they take it for their clients. Warren Buffett called it rat poison, squared. His partner one-upped him, Charlie Munger, said it's like harvesting, trading in newly harvested dead baby brains. WTF, Charlie? Seriously? Why does he say that? Because 46% of Berkshire Hathaway is financial services. He owns the legacy banks. He does not want this to be successful. I actually challenged Warren Buffett 3 years ago to $1 million charity bet. I would take Bitcoin. He could have, the S&P. Wouldn't take it. Good thing he didn't take it because I'm way ahead. But
well, great. You made excellent points. Thank you for that. I just want to ask if you can explain the phenomenon of mining and
yeah,
this whole question of the energy efficiency even comes in, and the proof of work and all of this stuff, because I think a lot of people are not clear as to what actually consumes all that energy.
Yep. So really quickly, and then I do have to run. So everyone knows what a data center is, right? You buy computers, you put them in a room, you plug them in, and you go find customers like AWS or Azure, and you sell the computing power. Those computers are CPUs, right? Big old mainframe computers or little servers or whatever, but they're CPUs. In the digital age, we buy machines, but they're not CPUs, they are GPUs or ASICs, just a different kind of computer. We plug them in, and now the cool part is we don't have to go find customers. We just sell that computing power to the network, to the algorithm. So the Bitcoin blockchain is a proof of work system. It is the most elegant solution to this age-old problem of, think about a song, right? I had a song, I want to share it with Mark. I make a copy of my song, I send it to Mark. He doesn't care. He gets the copy, it plays fine. I have the original. Who cares? The music industry cares. They want him to buy his own original. So now we all have to buy original and stream it. So in the digital age, right, we now have the ability to have digitally unique songs, digitally unique services. But the problem was money, right, used to be a bare asset. I used to have to physically give Mark $1. Then I could send him $1, but we had to have a bank in the middle, right, to say that Mark has $1 in his bank account, he sent it to Mark, and that happened. But they charge us both fees, and they charge a fee to transfer the money. Well, here's the cool thing. Satoshi-san, whoever he, she, they are, came along and solved, which is mind-numbing when you think about it, this problem. It's called the double spend problem. If I have an electronic dollar and I make a copy of it and send it to Mark, I'm now a criminal. I've just committed fraud, right? And it could happen because you could double spend an electronic asset by making a copy. What proof of work does is all of these machines say three things. One, Mark has a Bitcoin. 51% of the people on this call say, yep, Mark has a Bitcoin, check. That is immutable, set in a block, in a chain of blocks, okay? Second, Mark sent it to the other Mark. Yep, we all agree, 51%, good. That now gets recorded. Third, Mark actually has it, okay? That becomes a transaction. It gets immutably, and now there's no chance that I could have that dollar to spend because I sent it to Mark, or that Bitcoin because I sent it to Mark. So the proof of work is simply a cryptographically secure algorithm that allows us to prove ownership of unique digital assets. And what Eric Schmidt, who knows a thing or two about technology, said, which I love, he said, you know, the ability to have unique digital assets is a pretty big deal. I think some big companies are going to be built on that idea. And that is why NFTs are bigger than big. That's why DeFi is bigger than big. It's why Bitcoin, Ethereum, all of these things are much bigger than we all think they are, because it's the ability for the first time in history to create unique digital assets, digitally owned assets, identity, property rights, all of it in digital form, and transfer it seamlessly, effortlessly across the networks to each other and get rid of the middlemen. The WEF estimates that 7 trillion, with a T, are wasted every year on legacy systems. Why does it take 30 days to settle a bank loan? Because there are 7 systems. Most of them still run on COBOL. It was funny. I met with the head of Visa the other day, and he said, you know, we run on a mainframe. I'm like, you're shitting me. You run on a mainframe? He says, yeah, it's actually a moat because no one knows how to break into mainframes anymore because they don't know COBOL. And I said, well, what happens when it breaks? He says, oh, that's the funny part, right? When it breaks, we actually turn on a red light at the Sunnyvale Retirement Center, and some 80-year-old comes over and fixes it for us. I'm like, he's not joking, because my dad is 83, can still code COBOL because he worked with Arthur Andersen. So anyway, I'm going to run. This was fun. I appreciate the time. I appreciate the organization. If anyone has other questions, they can hit me up. I'm easy to find. I'm at Mark Yusko on Twitter. I'm at morgancreekcap.com on the internet. We have a bunch of resources on our website. I'm pretty reachable on DM, kinda, on Twitter. So
fantastic.
Thanks for having me.
This has been awesome, very educational. Thank you, Mark. And I'd encourage other folks to stick around. I think judging by some of the questions that were just cropping up, that there could be a bit more of a discussion going on. So round of applause for Mark.
All right. Thanks, guys.
Like I said, please, you know, join us at a future event. We'd love to have you in person for dinner when you're in town. Thanks again. Keaton, maybe we can have you lead the discussion. I'll try to get other people on the stage here so we can get everybody involved. Let's see, how do I do that? Guys,
I thought that was an amazing presentation. Is it possible for you to send us the actual PowerPoint?
Yes, we have. Well, actually, you know what? He didn't send me the slides. He was, but we do have the recording. So I'm actually going to stop the recording now because it's already a huge file, hour and a half.